Hi, everyone. Good evening. I'm Debbie Schwartz, founder of Road to College and the Paying for College 101 group. I'm just doing a little housekeeping, setting up Chris and myself as a spotlight just so that it's easier for people to see us. So, welcome tonight. This is officially called an AMA, or I guess it could be called an AUA, Ask Us Anything. And we've run these sessions a few times. They are really for the purpose of people to ask any question that they have related to loans. And, I don't know if there's anything else that you want to ask about relating to your students, like starting college. We can even talk about tuition insurance or, health insurance that might be on your bill. But we found these really helpful. You can ask a question in the chat, but also you can raise your hand and I will unmute you and you can just freely ask your question. So it might be easier to explain your situation. This is recorded, so we'll send the link tomorrow. And just for the purpose of kind of knowing who's here, if people can put in the chat where you're watching from, when your tuition bill is due, kind of would be interesting to know, like how close you are to having to figure things out. And while you're doing that, let me introduce Chris Upkarians. He's the co-founder of Juno, who we've been partnering with for the past several years. They have a very interesting platform, he'll explain more about, which basically helps to lower interest rates for families that need to borrow. And he knows a ton about student loans, having worked in this space now for a while. So Chris, I'd love if you can talk a little bit more about your background, and then we will see what people's questions are.
Sure thing. And thank you very much for the intro, Debbie. Thank you, everybody, for being here this afternoon or evening, depending on where you're at. I'm Chris Upkarians, and I'm one of the co-founders of Juno. And I've become a reluctant expert on almost everything related to FAFSA, Student Aid Index, financial aid awards, and student loans because 7 years ago, I was going to business school. And right before I started, I needed to figure out a way to pay for it. One of my classmates and I started an initiative, not a business, it was just an experiment to see could we bundle together a bunch of our classmates and ask different lenders in the market if they'd be willing to negotiate on the rates and the terms that they provided to our group. Many of them said yes. And when we met for the first time a few weeks later, we decided to try turning it into a business. So now the end result of that is every year we have a few 100,000 people who sign up on Juno many months before they even need a loan, typically. And over the summer, we make available to you the ability to check your rates without impacting your credit score and match any lower rates that you get from almost any other place, while also giving you cash back on your loans. So you can kind of think of it as it's free to join Juno. There's no hard credit check to see what you might be able to get. And our goal is to get you to shop around, not to trust us or anybody else that they'll have the best rate for you off the bat. And to be able to give you the best product by matching your low rate and giving you cash back. Happy to answer any questions that you might have about any of those topics. And thank you again for being here.
Yeah, I noticed people wrote in the chat. A lot of people have the tuition due kind of at the end of August. A few people at the beginning of September. Somebody has it due this Friday, so that's playing it tight. But anybody have any questions that you want to raise your hand, unmute yourself, and ask? I know sometimes it's hard to get started, but it really is kind of like beneficial if you want to, unmute yourself and ask a question. But here, I'll just read the first one that's in the chat. When you're offered a subsidized and unsubsidized federal loan, if you only accept the subsidized portion, will that affect what you might get offered next year?
Good question. No, it would not affect what you get offered next year. So what you're offered in your student aid letter is based on the FAFSA that you filed this year. And next year, you're going to file a new one. And that one's going to open in likely October of this year. And that'll result in a totally new set of calculations that the financial aid office goes through to create a new package. That won't be impacted in any way by what you're taking this year.
And just to kind of like expand on that a little bit for people, because a lot of people, I assume, who are on tonight, it's your first year that you went through, obviously, FAFSA and now the loan process. But if you received any sort of need-based aid, and if you want to continue being able to get access or have your student get access to the federal student loans, whether it ends up being subsidized or unsubsidized, every year you do have to fill out the FAFSA. So, and so that goes, Doreen, to your question. Every year that you fill out the FAFSA, every year the school will evaluate your financial situation relative to FAFSA, and they will determine, how much your student will get as subsidized and unsubsidized. So it will change year to year. And if you got need-based aid, that might change year to year. And as a factor with all of this, if you're taking out loans, you will be taking out new loans each year. So that's a question we get a lot too. Like, do I have to go through this process again every year? Unfortunately, kind of yes. So, but I guess you become more knowledgeable every year, and so that should help. So Chris's question, is it better to accept the loan for the whole school year or by semester?
This is a great question. So in my opinion, it's typically better to accept it for the whole year. And here's why. When you accept a loan, let's just pretend that it's $20,000 for the whole year and that you're attending a semester system. What happens is $10,000, so half of it, would be sent to the school in the fall, and the second $10,000 would be sent to the school for the spring semester, likely some point in January. You won't be accruing interest on the second half of that money until it's actually received by the school anyway. And so I do often hear people who are concerned that if they accept more money than they need for the first semester, that they may be accruing unnecessary interest. But because that second half of the money is delayed when it gets sent, that won't actually be the case. The second thing to consider is taking a whole year loan instead of semester by semester can give you just a little bit of optionality on a private loan. And by that, here's what I mean. Let's say you found a loan for, I'm going to make it up and say a 7% rate today, and you signed it for the whole year. So you're going to have $10,000 that is sent to the school probably around the end of August, and you'll start accruing 7% interest on that. As you're approaching your second semester, you know that you already have a certain amount of money that is being sent to the school that's going to accrue at a 7% rate once it does. But if something happens and you're able to find a lower rate between now and January, you actually have the right to cancel that second half of the money that's being sent to the school and replace it with a cheaper loan. And so it's a little bit complicated, but this happens all the time, and it just gives you a little bit more optionality in the process.
There's a question that's asking, is it better to accept federal loans first before looking for private loans? And I'll add to that, Chris, and this person didn't ask it, but this was posted in the group the other day. Somebody actually got a private loan at a rate that was lower than the student's federal student loan rate, and they were just wondering, why should they take the federal loans if they were actually able to find a lower rate altogether?
So let's maybe just great question, by the way, and it might be worth it for us to spend a minute or two on this. So when someone asks, is it better to use a private loan versus a federal loan, or what order you'd use it in, it's important to first just understand the two federal loan options that are in front of you. and when it makes sense to compare them against a private loan. And then finally, to kind of answer a bit more of the expanded version of this question that Debbie brought up. So the student is first allowed to borrow for the first year of school, typically up to $5,500. And most people will tell you to use that 5,500 that the student is able to get in their own name. And that if you need more money beyond that, that's when the federal government gives you an option called the Parent Plus loan, which currently lets you borrow up to the cost of attendance, or to compare the cost of that to a private loan. And I think that that advice is accurate and should still be held on to. So the reason why, so we can talk about what are the trade-offs between Parent Plus and private loans in a moment, but I really want to touch on why it's important to use that first $5,500 that the student is able to get in their own name. So let's say the student ends up working in a career field that qualifies for public service loan forgiveness, then truly the effective rate on that loan becomes zero, technically negative. It's not fair to compare and say, well, the rate on that $5,500 that my student can get this year, that's 6.39%. So if you find a lower rate than that, you might think to yourself, let's ignore that 6.39%, but it might not actually be 6.39. That's just the highest it could be. The second reason is, and when I say that, I mean in case that loan got forgiven if they went into certain career fields. The second reason is that there is a new repayment program that is rolling out in July of 2026 that a student taking that $5,500 will be able to use once they graduate. And the way that repayment program from the federal government works, it has some complicated math behind it, but at the end of the day, what it means is that the true rate on that loan might end up being a lot lower than 6.39% if the student is not making a higher income. And I'm happy to talk more about how some of that math works. But that 6.39, that's really the highest that it's going to cost. And in many cases, it could be a lot lower and you won't know until after graduation. So it's safer to actually use that.
And what about the concept of if I could get a private loan that's really less altogether, like significantly less than the federal student loans? Should my student take any of them out?
I would still use that federal direct loan in place of a private loan. But this is truly a matter of personal opinion. So the way that I think of it is, if you have a lot of confidence that you're going to end up working in some high paying career and you don't think that it's risky that you won't end up doing so after graduation, then sure. In that scenario, you wouldn't really get benefits of having that federal student loan in the student's name. But in any other scenario, you might end up using some of those benefits that come with that 5,500 that the student can borrow. And those benefits could mean that the actual cost of that loan, by the time you're done paying it off, could be a lot lower than 6.39%. And so it does come down to really just your level of confidence. The last thing I'll just leave you with on this is there aren't many cases in which you're going to get a private rate that's lower than 6.39% that's offered to the student directly anyway today.
Yeah, and you're right. And I should clarify that. You're absolutely right. The person asking, it was a student loan that the parent was co-signed on.
Got it. Which makes sense. Yeah. And even on co-signed loans, it's pretty rare to get something below 6.39%.
Okay, so somebody is asking, is it better, does editing or submitting the FAFSA now do anything for aid and loans this year?
It's an interesting question because it's theoretically in most schools, it wouldn't at this point in time. But there are some schools at which if you edit the FAFSA, the school will receive some new information a few days later. But most schools at this point, they aren't going back and looking at updated versions of that, what you input in FAFSA. They've already created a student aid package for you based on what they've already got in front of them. There are some cases where you can talk to the school. If you know that you did something wrong, as in you entered something incorrectly that may have made it look like your family had more assets or more income than you actually have, you have an opportunity still at some schools to reach back out to the financial aid office and let them know what that was and ask them if there's anything that they can do to help you. And they will talk to you about it. But if you simply edit your FAFSA form itself and expect that to change the results, that won't really do anything without actively communicating to the financial aid office and asking if they'll consider it and if that change would even result in a greater amount of financial aid to you and your family.
But I will just add that, I mean, if you have had something, substantial happen, God forbid, if a parent might pass away, that, those types of situations, you should obviously contact the financial aid office, and they will definitely take that, into account. So,
Absolutely.
yeah. And maybe, Chris, just to add a little bit to this conversation about when people fill out FAFSA, and just maybe if you want to talk about, like, I think that people think, oh, I had to fill out FAFSA last fall, you know what I mean? And because I didn't, then I can't access anything this coming year. But the reality is, in theory, somebody can really fill out FAFSA for a much longer time than they realize.
Yeah, actually, it's a good point. So there's a lot of you might read things that say FAFSA opens on this date. I think last year it was November of 2024 is when FAFSA opened for anybody going to college this fall. And there are a lot of people who say fill it out quickly. If you don't fill it out quickly, there could be problems. And that's partially true, and that there is some buckets of free money, especially buckets of free money from the state and sometimes from the school, that do come on a first come, first served basis. But most of the funding for college is coming directly from the federal government in programs that you still have access to, even if you fill out FAFSA much later than when the form actually opens. The federal student loan programs that are available to you and things like Pell Grants, which are free money that doesn't have to be paid back if you have a high level of financial need, those things are designed to not have really very much of an end date around them. And so if you have a semester that starts and you need money halfway through, but you haven't borrowed money yet, you actually still have time to fill out FAFSA and ask to borrow money to help pay for that semester, whether it's for the tuition and fees or for living expenses beyond that. Bottom line, it's not too late. You can complete the FAFSA in less than a day, and typically the school will receive the information from your FAFSA within 3 days. The one thing I'll just kind of add on top of this is because I've had this conversation with probably 20 people this week. A lot of your student aid awards might show things like this is the cost of attendance, these are the grants and scholarships available to you, and these are the Stafford or direct loans that are available to the student. And I've seen a lot of cases where it doesn't explicitly call out that you also, as a parent, have access to Parent Plus loans. And those Parent Plus loans are, again, money from the government that lets you fill the unmet need on that student aid bill. But you don't just get that by filling out FAFSA. You actually have to fill out a separate application on studentaid.gov. That application itself takes about 15 minutes, but just do make sure that if you're planning on using the Parent Plus loan, that you have explicitly filled out that other application. FAFSA alone doesn't get you those funds.
Good point. I've definitely seen confusion when people write, like, where do I get the Parent Plus loan? And they don't know where to actually start the application.
Yeah.
Okay. This is a quick question. You kind of reference it a little bit, but somebody's asking about the actual dollar amounts that their student gets access to in federal loans. So it's $5,500 the first year, but then what happens in sophomore through senior year?
assuming the student is a dependent student, which is the definition that the Department of Education uses, most people end up being dependent students. So the amount that they're allowed to borrow for their first year, that's 5,500. For their second year of school, it's 6,500. And for their third and fourth year, they can borrow 7,500 in each of those years. It is importantly a use it or lose it program. So if you don't use the $5,500 that's available to you for freshman year in your second year of school, you're still limited to $6,500 of borrowing. You can't go back and use the portion from freshman year that you didn't otherwise take advantage of.
Another question about if somebody doesn't want the loan or need the loan for first semester, should I wait until the second semester to take it, or is there any advantage to taking it now, or can they even take it now and not have it dispersed the first semester?
This is a really good question. So you absolutely can take it now. And when you get an application, and this is true for both the federal loan and the private options, you typically have an option from a drop-down list that asks you which term you're asking for the loan to be dispersed during. And so one of those options is typically full year. Sometimes it's written as spring and fall. And often enough, you have an option that says fall only or spring only. And if you're on a quarter system, the same logic would apply. And so you could, if you wanted to, apply for something for the spring term only, and the money would just get sent at that point in time. For a federal loan, it doesn't really matter if you what you end up doing, because the rate won't change. If you want a spring loan and you are crunched for time right now, you can wait 3 months or 4 months, and the rate is going to be the same if you apply then as if you apply now. But for private loans, the rate could change depending on what happens with the broader economy and interest rates. So one way to think about it is, if you do get approved for and signed for a private loan, where you select that you want the money sent to the school in the spring now, that's really the worst rate that you'll get. It's an option that you have in the back of your pocket, and you can continue to shop around for the next few months. And if broader rates in the economy go a lot lower, you might end up getting a lower rate for the spring.
Okay, the next question, I knew it was coming, but I think you'll have to kind of give some little bit like background information. And it's basically somebody's asking, I've seen a lot of people talk about getting grandfathered in this year. What does that mean?
Very good question. So on July 4th, there was the big budget bill that was passed into law. That budget bill impacted a lot of things, and very specifically had some changes to the Parent Plus loan program. And what it says is that there's now basically two groups of students and parents, and different rules effectively apply to each. You can think of today's group, anybody whose children will be in college this fall, or anybody whose kids have already been in college, and this might be your second, third, or fourth year of school. You get access to, let's just call it the Better Parent Plus. Better Parent Plus is how things work today. The key thing about it is that it allows you to borrow up to the cost of attendance, minus the other amount of scholarships and grants and aid that has been received for that year. And so if the university that you're going to costs $80,000 a year, you can theoretically borrow up to $80,000 for this year through Better Parent Plus. Starting next year, for anybody who is going to college for the first time in the fall of 2026, the limit on Parent Plus is brought down to $20,000 for the year. And there's actually a $65,000 lifetime limit on Parent Plus. What that means is that if let's say you have a child who's starting their freshman year in the fall of 2026, you can borrow $20,000 for each of their first, second, and third year, and $5,000 in their fourth year through the new Parent Plus. However, if your children are in college this fall, you can be grandfathered into Better Parent Plus for 3 years after this year, as long as and there's a little bit of debate around the exact way this is implemented, but the safest way to think about it is make sure that you have at least some minimal amount of Parent Plus loans that have been borrowed for that school this year, or really before June 30th of 2026. As long as you've done that, then you should be grandfathered into Better Parent Plus, which means that for the fall of 2026, for that academic year, you don't have a cap you avoid that $20,000 Parent Plus cap. Happy to go into that in a little bit more detail, and I'm sure we'll get some follow-up questions here like we did last time, but thanks for that question.
Somebody is asking, they said they took out a loan for the second semester of this past spring. That loan happened to have been with College Ave. And they applied for a new loan for this coming year. And the new loan came in at a lower rate than what they had last year. Two parts to the question. Can they actually combine the loans and add the amount from last year to this new loan that has a lower rate? Or can they refinance in any way to kind of get the lower rate that is now out there?
This is a really good question, and it's two ways. I'm going to give you three really quick answers, then I'll just pause for anything else that we might need to touch on. So first is that you're generally not able to refinance a student loan until in this scenario, until the student is in their final semester or term at school. That's not universally true, but there's one company that has on occasion allowed you to do this, and that's called Floral Road. But even they may not right now, I don't know for sure. Most would not let you do that. The second part of this is you can't take the College Ave loan that you borrowed last year and kind of roll it into the new loan at a lower rate. It's not really a process that exists, but there is one little workaround that you can, I'm going to just call this, and I'm making this up here in terms of the term. We're just going to call this the manual refinance. If you borrowed $20,000 last year at a higher rate, you are allowed to, let's say your borrowing limit for this year is higher than the amount that you actually need for this term. You could actually just borrow more money this year than what you think you need to pay for this year, and use the extra amount that is left to prepay last year's loan. And so that manual refinance option is something that's available to you because there's no prepayment penalty with those student loans. And it wouldn't be too difficult to do that either.
So I've never heard this, but I like the idea. Let me just ask you, Chris, but you still can't borrow more than your cost of attendance. So you're just saying if like I had enough resources and maybe what I owed the college was 20,000, but I could actually pay 10,000 of it. I could actually take out. It's basically if you can take out more than you actually need to pay them. I'm probably not saying that well enough, but yeah. Okay, I just didn't want to get people the impression that they can take out, like if they have to take out whatever they have this year and it covers up to cost of attendance, that they can add on what they borrowed last year above the cost of attendance.
This strategy was really popular in 2021 and 2020 with a lot of my classmates and friends, by the way, where people who maybe otherwise had This is during COVID when rates fell dramatically. And a lot of people trying to find ways to do this. But you're right that the key limitation to your ability to do a manual refinance is whether you're able to borrow more this year than what you actually need to be able to send to the school. And that's going to always be below the cost of attendance minus the other aid that you've received.
And Georgina is asking, is this something that they can do through Juno? How could they get more information about it?
Uh, this is not something that you could explicitly do through any lender. It's more a scenario where I'll just walk you through how I think of the workflow in my head. So let's say you've taken out, and by the way, if anybody wants to talk about this one-on-one later this week or later, I'm more than happy to help you think through exactly what you need to do. But let's assume that I have the borrowing capacity and that's not an issue. I borrowed $20,000 last year at 8% through College Ave. And this year, I am able to borrow, I only need $20,000, but I'm able to borrow $40,000 and I'm able to do it at 6%. Then what happens is I apply for, get approved for, and sign a loan for $40,000. It's that money is going to get sent to the school. There's going to be some, assuming $20,000 extra that I don't actually need, that is going to get sent back to me, or that I'll get access back to after tuition and fees are deducted. And then all I'm going to do is take that $20,000 that gets sent back to me by the financial aid office, and then log into the servicer that handles my loan from last year and just select that I want to pay $20,000 towards that loan. And then that loan will be paid off. So I'll just have this new $40,000 balance at, let's say, 6% that's accruing from now.
Chris, you guys should write that up because I honestly, that scenario applies any year where the interest rate has, is lower this year than it was the previous year. And as you said, the person has the borrowing capacity.
Yeah, I would agree. I think we should. I will.
Okay. For a 529 plan, is it better to send the money electronically direct to the university or have the money put into our personal account?
To be completely honest, I'm not sure if there's going to be a difference here as long as the end use of the funds is directly for education purposes.
Right.
I don't think it should actually matter.
No, it shouldn't matter. It's probably from a just pure record keeping standpoint, simpler if the full distribution of the 529 that you're taking out is going to cover, tuition, then I would send it directly to the school. If you need some of that money to cover other qualified expenses, then of course, you might want to have it sent to your account so you can use whatever you need for the non-tuition expenses that are still qualified, and then send the rest to the college. So it kind of, as Chris said, it's not going to really make a difference one way or the other. It kind of depends what you're going to end up needing to use the funds for.
There's one additional thing that could make a difference that we actually spoke about in our last Ask Us Anything. And that's, let's say you have somebody else, a grandparent or another family member or somebody else who wants to help contribute towards your child's education. As long as they are paying tuition for that program directly to the school, then there's basically there's a gift tax exclusion.
Right.
And so if there's somebody else is going to help contribute and they're not contributing from the 529 plan, please just do make sure that they're paying the tuition funds directly to the school.
The next question is asking about covering sorority dues. They're saying, I'm getting conflicting information about using college loan funds, either private or federal, to pay for sorority dues that are not billed directly by the university. The school financial aid department said that you can use the funds for sorority dues as long as you are not taking a loan for more than the difference between the cost of attendance and the financial aid.
Yeah, it's a good question. So this is actually short answer is yes, you can use those funds for sorority dues, and the reason why is that cost of attendance number. It's made up of your tuition and fees plus some assessment for or projection for how much your living expenses would be for rent and food, plus a little bit of extra money for personal expenses. And you can kind of just think of it as that the sorority dues are coming out of that personal expenses bucket of the cost of attendance number that the school has already created. But so it's up to you how you use that. Some people might use that personal expenses portion for something besides that. But at the end of the day, the only limitation is that cost of attendance number. And what the school is going to subtract out is simply going to be the tuition plus the mandatory fees that should be clearly laid out on their financial aid page. Everything beyond that is for you to use towards everything that you'll spend money on for that year.
Next question is, just to clarify, is it true that PSLF cannot apply to Parent Plus loans?
So there is a kind of like a backwards PSLF option for Parent Plus loans. I have a little bit more of a detailed write up that I'm happy to send to folks, but it's much more difficult to qualify for. And I candidly am not 100% sure if it's going to apply to the new repayment programs
That's
that
what
are
I
going
was
into
gonna.
effect.
That's what I was going to
Yeah.
ask. I think that's the concern. I mean, not, but at least for
Yeah.
me, or understanding is that even though maybe you could do it this year, like, is what you can do this year related to PSLF and Parent Plus loans going to apply in future years?
I'm not sure yet. There
Right.
hasn't been enough detailed guidance that's been provided on what the new policies that were implemented. So two new repayment plans were passed. There's still some stuff that's going to get hashed out by the Department of Education for how those apply to different programs. I do believe some of the rules around whether things would apply to PSLF or not are already settled in there. My first read when I looked at this last week was that it seemed unlikely that PSLF rules for Parent Plus were going to survive those new repayment programs, but I'm not definitively sure.
Okay, next question, which we've gotten before, which is a good question, is somebody asking, will they get a better rate if they are a co-signer on a student's private loan versus taking out the private loan themselves as a parent? And are there any pros and cons if they take out the parent loan by themselves and something unfortunately might happen to them? What happens to the liability of the loan?
Really good questions. So for the first question, and just to restate it for everybody, it's just about you have two options when you're applying for a private loan. You can either apply under something called a parent-only loan, which is what it sounds like. Only the parent's name is legally on the loan and only their credit is pulled. Or you can do a co-signed loan. Over 90% of loans are co-signed, but that means that both the student and the parent are legally on the loan and jointly liable for paying it back. There is typically not a difference in the rate that you get charged in some cases between one and the other, but more often than not, you do see that a co-signed loan has a lower rate than a parent plus loan, but typically a small difference. The way to think of this is it is the parent's credit score and income that is what lenders are typically looking at when you apply for either a parent plus a private parent loan or a co-sign loan, because the student, even if they have a good credit score, doesn't have long enough credit history or income to actually impact the rates that you would see. But from a lender's perspective, if there are two people attached to the loan, it's still a little bit less risky than the loan that's in the name of the parent only. But in most cases that I've seen, the difference in rate that you'd see between one and the other is typically quite small. That can change from time to time, but could be quite small. To the second question, it's a really good question. So In the case of both a parent plus loan, so the money from the government, and a private parent loan, if something does unfortunately happen to the parent, then that loan is discharged. So that falls under the basically part of your loan document that talks about death and disability discharge. And that if that happens, then there's nothing happens to the student's finances. It's just kind of as if that loan didn't happen. But in the case of a co-signed loan between a parent and a student, if something unfortunately happens to the parent, then those loans are typically not discharged. The student is typically still on the hook for paying it back.
And what happens, I mean, if something happens to the cosigner, does the student get the chance to find another cosigner?
It's a very good question. I don't believe that they would be required to find another cosigner because a lender doesn't just call the note, so to speak. They're not just saying, you now owe us all this money all at once. Not really feasible, but it would be kind of as if that loan becomes a primary or a loan without a cosigner.
So the kind of the original terms stay, it's just now one borrower on it instead of the two with the cosigner.
Correct.
Okay. Next question. If you previously co-signed for a private loan for an older child, does that affect the rate you might receive on a different child who you're applying for loans for? And is there any chance, because you already have loans with an older child, that you might have a higher chance of being denied with the younger child?
Yeah, great question. And so the short answer is yes, it can impact things. And it can impact both the rate that you might get as well as the chances of being approved in the first place. Now, what that impact is varies significantly from one person to the next because what the lenders are typically looking at is your debt to income ratio. And so there's some cases in which what we just spoke about makes no difference at all. But in other cases in which it can actually result in you no longer even being eligible for private loans from most places. And so the things to just kind of keep track of are, have you added the action item that might be just helpful for anybody to hear would be that if you are likely to seek a private student loan for one of your students this year or next year, then there are many cases in which it would be helpful to not buy something else with debt, such as let's say a
Car
car or a
loan,
boat
yeah.
or something else, because that could impact things and potentially just be avoided until after you take out that loan.
There's a question about this parent has gotten the best rate so far from MIFA. They haven't finished signing the paperwork, but the loan is currently in their student's name, and it says our names. And then he says, I'm the borrower, but my wife and son are the co-borrowers. Is that the right way to handle it? Is that even possible?
I didn't think that it was possible, as in to the best of my knowledge, private student loans that typically just have one primary borrower, one co-borrower, or
Right.
on the application and on the loan. So I was just double checking. It's not. Is it theoretically possible that a lender may allow that? Sure, but it may not be set up
It's not the
way.
normal
Yeah,
situation that we hear. So yeah, I would say the same. I don't know 100% for sure the details of how MIFA, would allow that, but it's unusual.
yeah.
So I would and what's unusual about it is the concept of having the cosigner and then somebody else, like having three people basically on the loan. It's usually two.
Exactly. And so the most likely scenario, just to maybe answer that question directly for the right way to handle it, would be that it's probably already set up this way that you and your son are the co-borrowers in the loan, or that your wife and your son are the co-borrowers in the loan. But less likely, as Seth is mentioning, that all three of your names would be on the loan.
Okay, so somebody is also asking about the Parent Plus loan and the PSLF because they work at a 501c3. And they had heard that if the Parent Plus it would need to be consolidated with the student loan before July 2026 to be eligible. And they're concerned about taking a private loan because it doesn't have any of the forgiveness options or protections that a Parent Plus loan gives. Maybe do you want to explain to people like what protections do come with a Parent Plus loan because they are part of the federal government that private loans might not have? And then is it possible to do anything with a Parent Plus loan and consolidate it before 2026?
So I'm going to ask you to give me to come back to this question because I just want to pull up the notes that I have on exactly how this works. I have a like 2-minute version of this that I just wrote up for somebody, but I don't want to misspeak because
Okay.
this double consolidation loophole that allows somebody to get increased access to loan forgiveness is a little bit complicated. I'm also happy to send the written version of it.
Okay, so we'll come back to that. So the next question actually is not a loan question. And I know something about it, but I'll see if you want me to answer it or not, Chris. People are asking about there's this product called, or company called Mama Bear. But basically they offer legal paperwork that parents should have in place. And so let's see, the question is, I thought that was always, somebody is saying, do we have any information on whether or not parents should fill out these forms? I think it's what people, it's what if something, it's to cover what if something happens to your child and they can't communicate, that you can now make decisions for your child. I thought that was always my right as the parent since there's no other next of kin. So, I mean, I think really what so basically, this isn't actually something that relates to just your child going off to college. It relates to somebody turning 18 and falling under the HIPAA laws or HIPAA regulations. Technically, the doctors or hospital, if somebody is 18 and older and they're taking care of them, they don't have to communicate with anybody else. So, if that person is incapacitated, and so that's why people have these forms so that if they're in that type of bad situation, that they can let the hospital know that that legally they can be communicating with whoever is on those forms. So you don't have to go through Mama Bear, but I personally think it's important that you have some, some forms that are filled out. I'm trying to think of, there's actually several different legal forms that you should be looking into. So, right, durable power of attorney for finances, medical power of attorney for healthcare, and basically, just looking it up quickly, it's the HIPAA authorizations that are critical for allowing the sharing of medical information between trusted individuals, even family members. Again, it's because the person has turned 18. So Definitely you should look into it. Next question's asking, does having multiple children in college help you get more grants? It seems like we received less aid this year with a second child in college.
This is a really good question with a slightly complicated answer. So the FAFSA form asks you, so the short answer is it can help you get more in grants, but there are some actions that you may have to do and things that you might want to pay attention to for next year if you have multiple children who will be in school at the same time. So the slightly longer version of this answer is that if you have on the FAFSA form itself, one of the questions asks you how many other people in the student's family will be enrolled in college for this upcoming year. And you, let's say, put two because you have two children who are in college and this fall. Nothing happens with that data. It used to, but the FAFSA form changed a little over 2 years ago. And since it did, the fact that you have 1 or 10 children in college at the same time doesn't change the math that the Department of Education uses to calculate your student aid index number. And that number is what the financial aid office uses to allocate aid to you. Now, you don't need to necessarily know all of that. You just need to know that in order for your financial aid office to take into consideration that there are multiple children going to college this year in your household, and that would represent a greater strain on your household's income and assets, you have to actively tell them that. You actually have to submit what's called a financial aid appeal and communicate to the financial aid office that that you have this other number of children in college this fall, and that this is the cost for each of their programs so that they have the opportunity to consider it. Without you doing so, they don't automatically know about it.
It was a tough change that happened on the FAFSA. Not a lot of people were happy about that.
It's quite silly that that number isn't used automatically.
Yeah.
By the way, it's like you're still asking that question. A lot of people are assuming that that question is being used, but it's not at all obvious to anyone that it's not.
Right, right. And for families that had multiple, had multiple kids in school at the same time, it's a tremendous impact. Okay, if your child is going to end up taking a 5th year, can you still get federal loans? And would it be for the $7,500 that they got in senior year?
So yes, so 2 ways to answer that. There's a lifetime cap on that. So this is the direct loan the student is able to take out in their own name. And theoretically, you're allowed to use it for more than just 4 years. There's a lifetime cap, though. That lifetime cap is $31,000. And what that means is, depending on, there's for your 5th year, a $7,500 annual cap. If you have borrowed, but that $31,000 lifetime cap basically can reduce the amount of borrowing capacity that you have left in your 5th year, depending on how much you borrowed through the program for the first 4 years.
So they can borrow, but this applies to a lot of what we're talking tonight. Plan ahead. Plan how you expect to pay for all 4 years, because the worst scenario is that your student is in college and for whatever reason you can't figure it out, and they've incurred some debt, and then they have to drop out because you can't finish paying all 4 years. It's really the worst statistically, and all the studies show that person ends up in the worst financial situation of all types of students, because you've incurred debt but you never got the degree.
And to answer this question a slightly different way, if you maxed out, let's say the student takes the maximum amount that they're allowed to through the direct program for their first 4 years of school, that would be $27,000. And for their fifth year, they'd have $4,000 of remaining capacity in the direct loan program. And so hopefully at that point, it's just one more semester or quarter that they have left to finish. But this becomes even more impactful when we think about the new limits that are coming in place for Parent Plus. The way that that would work is you still would have the $65,000 lifetime cap. So by the time we get to the fourth year of borrowing for college through Parent Plus under the new limits, this is for anybody who's not going to get grandfathered in, there's only $5,000 left in borrowing capacity in your fourth year. And then nothing left over in your fifth year. You'd then only be able to use a private loan and hopefully be able to qualify for one at that point. So just like to double down on Debbie's point of how important it really is to plan for all 4 years to try to reduce the amount of time to graduation as much as possible, and perhaps even more so than in the past. And to take those limits into consideration, especially for any children who may be starting college in the fall of 2026, because you won't have the better Parent Plus to fall back on.
And maybe just kind of like continuing with that, because there's a question. So how exactly would people go about if they wanted to take a private loan and take out the Parent Plus loan, to be grandfathered in this year? Do you want to talk about, are there minimums that people can take out for the Parent Plus loan? And how do they go about kind of with these multiple loans, make sure that everything is covered for the college?
Yeah, good question. So let's go with first question. Is there a minimum? Second, let's maybe just talk about for a moment why it matters to have a loan on the books on July 1st, 2026, at least in my opinion. And then we can talk about what this looks like in terms of the borrower's point of view. What are the loans that you have that are living out there? And does that matter for the long term? And stop me if I'm going too far in. But first question, keep it pretty short. The minimum is, there's no minimum for the perspective of the federal government on how much a parent can borrow through the Parent Plus loan program for a year. However, some schools do put a $100 per term or $200 per academic year minimum on the size of loan that they are willing to process, because there still is some work that happens that the financial aid office has to do for that loan to be dispersed, which just means received by the school. And so you can theoretically just take out $200 to, even if you don't need a loan, just to maintain or get grandfathered in. The second point just to make on this is we don't know for certain exactly how the Department of Education is going to implement the grandfather, meaning there's going to be somebody who's sitting at a computer saying, all right, the law says that the law says that if anybody has had a loan dispersed for that school before June 30th, 2026, that we can grandfather them into Better Parent Plus for 3 more years. But we don't know if exactly how they'll do it, and I won't worry with the details. The safest way to make sure that you'll get grandfathered in, almost no matter how they decide to implement this, is to make sure that you have at least $1 worth of Parent Plus loans for that school that are still outstanding as of July 1st, 2026, which is the date they're supposed to determine who gets grandfathered and who does not. So don't just take out the minimum Parent Plus loan and then pay it back a week later. Maybe just allow that to sit in your as a loan until July 1st or the first week of July of next year. And then the third thing is, you are, no matter what the situation looks like, likely going to end up with a lot of individual different loans from different places. Whether you use all federal or a mix of federal and private, the unfortunate reality is that these loans, for federal loans, let's say if you just ended up, the student would have 4 different loans, one for each year of direct loans that they borrow. The parent would have a different loan for each year for Parent Plus if they were borrowing that. And they might also have a different loan for each year for a private loan. if they're borrowing that. But after graduation, for the federal loans, you can consolidate them, which really just means there's a process where the federal government lets you take all of those different loans for each borrower and combine them into one larger loan with a weighted average interest rate so that you're not paying more than you would have after consolidating, but you have simplified things down to one payment and one place to send that money to make it a little bit easier on yourself. You also have an option on both the federal and the private loans to refinance those with effectively another lender who writes a check to all of those different places and pays those off, gives you a new loan at a new rate. And in some cases, in most cases that we see, you would want to refinance a loan if you're getting a lower rate at that point than the rate on the loans that you had previously taken out. And that is often possible because once a student has graduated, they're viewed as being, and once they've secured a job offer, they're viewed as being more likely to pay that loan back than when they were a full-time student and that money was originally borrowed.
Okay, here's another important one, which has come up a lot too. But this is for students who are interested in going to medical school. And this family is understanding the impact of the bill that was just passed, and knowing that there's going to be caps on what the student can borrow, even to go on for a professional graduate school. So what's your advice that for students who want to go to, quite honestly, expensive graduate school programs, how should they be thinking about it now and potentially planning about it even as part of undergraduate?
So let's just recap really quickly on what those changes are. I mentioned that in July, the budget bill included changes to Parent Plus. It also included very significant changes for graduate students. And thanks for this question, because I think it's touching on some really important points here. The way graduate student lending works today is that you can theoretically borrow all of the money that you need for medical school, law school, master's in social work, or any degree from the federal government. It kind of works like the Better Parent Plus, where you're able to borrow up to the cost of attendance. Next year, and ignoring the grandfather conversation, next year, let's say you're a new student going to a professional degree program, which is defined as medical, dental, law, veterinary medicine, and a few others, then you're allowed to borrow $50,000 per year. Most of those programs, by the way, cost a lot more than $50,000 per year, even most of the public schools that offer those degrees. And so most people will be limited by that $50,000 from the federal government, but they'll still be allowed to borrow private loans above that $50,000 they can access from the government if they do still need funding that's available to them. And if that's not possible, then you'd want to really plan to apply to or go to a cheaper school, because there is no release valve or backup option in funding from the federal government at that point. If you're going to any program that's not a professional school for a graduate school, and so you can think about it as like an MBA or a lot of 2-year or 1-year programs, or PA, or most nursing, then you're actually now limited to $20,500 of borrowing per year. And almost all of those schools are going to cost more than that. And so the bottom line is, you can no longer rely on the federal government to be the primary source of funding for a lot of graduate students. And many families will need to either go to a cheaper school or identify a way to use private loans to help fill the gap of whatever is left. And the last point I'll just make on this is, if you know that you're going to be if you're going to a dental school, there's no way that you can choose a cheaper school. You're going to have to find some way to likely borrow more money or use more savings to pay for that. And if using more savings to pay for that is not a realistic option, then pay very close attention to your existing credit score, to the other loans that you'll take out between now and when somebody will be going through all of medical school, trying to make sure that you'll be able to keep your debt to income ratio in a certain range so that that student will be able to use you as a cosigner and pay for the entirety of their 4 years in medical school.
So
Unfortunately, there's a better answer. Sorry.
are there cosigners on loans for graduate programs?
We're working on reducing the, I'd say, prevalence of cosigners being needed. So if I back up for a second, most of what Juno does is for graduate students. We started off doing this for MBA programs. We do a lot of stuff for MBA and law programs today. And with the biggest thing that we've worked on is removing the requirement for a cosigner for those degrees. I can't guarantee that we would be able to, or that I'd say any lender would remove the requirement for a cosigner for a medical or a dental degree in the future. But I think that some of them might. No guarantees, no promises. It's something that we're working on right now. There are three big problems for somebody who's going to go to graduate school for the first time next year and on that Juno is working actively to solve. The first problem is what we just mentioned. Can you let many more students apply without a cosigner than otherwise would need to? Because that constrains the ability for the parents to really live their lives or do what they need to do. The second is that a lot of lenders require, for a non-cosign loan, they require you to show full-time income. And that's exceedingly challenging to do when someone is a full-time medical student or a dental student or a law student. And so there are things that we've long been working on to make that an easier requirement for most people to pass. And the third thing is just making sure that people have an option to defer making large payments until after residency for doctors or judicial clerkships for lawyers who might end up doing one for 12 months after graduation. And that is quite likely to be able to work. I would be somewhat optimistic here in that I do think that the market is going to solve for a lot of these cases. I would just be prepared in case those fixes don't come in place within the next 12 months, because this change that will impact a lot of people going to expensive graduate schools is happening very quickly. And a lot of people are trying to adapt to it more quickly than they naturally would.
And just something else to consider, since your student hasn't even gone through undergraduate, and it's great that they have these ambitions of wanting to go to medical school, is you really should pay close attention to the cost of undergraduate. So the lower that you can take, the lower the cost of the undergraduate, then either the more savings that as a family you might have to help the student out in medical school, or the less that they will have had to borrow in undergraduate. Not that it doesn't increase their limits, but it might make them, just a little bit financially stronger from a profile perspective if they have to go borrow for medical school. So, good to know the long-term goals, and definitely use that to kind of change maybe, or be careful at what's happening now in undergraduate years. Okay, so here's a question from a parent who has twins. I have twins heading to college this fall. Any suggestions for the best options to handle loans for multiples? Do we need to obtain one loan and disperse it to multiple schools, or do we have to have two separate loans and apply and have separate people, or apply, or how do they handle co-signing with loans for multiple or twins?
It's a great question. Unfortunately, each student is a separate loan application, even if they were going to the same school. And so you would have each student plus you apply, or plus the other parent, as a student and co-signer combination. And each one of those is just going to be a different loan application that gets sent to the school.
Do you want to talk a little bit about, particularly for parents who have twins, but just Oops. Any other like type of situations where does the same person have to be the co-signer year after year, or is there benefit from um, switching off on co-signers?
Same person does not need to be the co-signer from one year to the next. And there can be a material benefit of switching co-signers from one year to the next. The reason why is, think of it as that for private loans, if you want to keep the option open of qualifying for the best rates on private loans in the future, then one of the things that's partially in your control is keeping your debt to income ratio as low as you can. Uh, Ideally, that would just mean increasing your income materially. That's less in your control. If you have one parent who is taking on the debt on their credit report as the co-signer every single year, then the debt portion of that ratio is going to be really large for that parent, and it's less likely that they'll be able to qualify for something in the future. But if you are spreading it out a little bit between each parent, then there are many cases in which that becomes the right decision to do. And so, short answer, it can make sense, but it's not a universal that will always make sense to do so. It'll actually just depend on what other debt you have and what your income is.
Here's a good question I hadn't really heard of or thought of before. This person has their child is going to technical school for this year, but they're heading to a 4-year school next year. Can they still be grandfathered in, or will it be counted as a different school?
Uh, to the best of my reading of things, it would be counted as a different school. And
Uh,
so there might still be some changes that happen to this through implementation and rulemaking, but the part of the way that this is all written was to say that the grandfathering occurs for that program and that program only. And so if you're going to UCLA and you this fall and you take out a Parent Plus loan, you're grandfathered into being able to use current Parent Plus for this upcoming academic year and 3 more after. But if you transferred to another school year 3, then it's not likely that the grandfathering would carry forward. That being said, this could change. The interpretation of how this actually gets implemented could change slightly. I just wouldn't rely on that when I'm budgeting and planning for the next year.
and there's looks like one more final question about, does a parent's age impact the interest rate for a loan?
No, it's not legally allowed to. But good question.
Okay. So I've actually put in a few times into the chat the link to Juno. I encourage people to sign up because it's free. And maybe you want to explain one more time, Chris, about like the rate matching and what people have to do to kind of do that rate match.
Yeah, absolutely. Thanks for the opportunity. So the way the rate match process works is if you find you can check your rate on Join Juno in less than 3 minutes without impacting your credit score. That doesn't lock a rate, it's not a full application, but it gives you a very good sense of what might be available to you. And we know that for a lot of people, what's shown to you on that screen might not actually be the lowest thing that's available to you. Lenders are very competitive in August. Some of them are changing rates pretty quickly from week to week and day to day. And so we're encouraging you to shop around. And as you shop around different places, if you find a lower rate from a very long list of competitors, then we have a process where we can match that lower rate and pay you 3% of the loan amount that you're taking as a cash bonus for having gone through the trouble of that rate match. And from your perspective, what you would need to do to claim a rate match would be to get approved for a loan from whatever that competitor is, at a lower rate, and to submit an application at one of our lending partners that we have clear instructions for. It'll take about 15 minutes on each of those. And then you email hello@joinjuno.com, and somebody just walks you through the next steps. There's only one more step really for you, which is uploading a specific document that just proves that you were approved for a lower rate somewhere else. And then there's really nothing else that you need to actively do there. So it might sound more complicated than it is, but at the end of the day, it's just shop around. You'll apply for 2 places, you'll upload one document, you'll get the lower rate, and you'll get 3% cash back.
And in theory, as we've learned tonight, parents have to take out, or students, have to take out multiple loans throughout the 4 years. They're probably going to have at least a loan per year. Can they do this process again next year, Chris, or can they only do it the first time?
But you can do it every single year. Yeah, great question.
So somebody's saying if you apply to 2 places, won't your credit score be impacted?
This is a great question, and I'm glad we have time to touch on this before we wrap up. So according to Experian and TransUnion's own websites, as long as you are shopping around for the same type of product within a 30 or a 45-day window, your credit does not get impacted anymore for that second credit check than it did for the first. It's meant to not penalize you for shopping around for a better rate. That being said, you are able to check what rates are available to you for student loans without doing a hard credit check at many places. And one of the ones I'd recommend just checking is credible.com, which will let you see rates from a handful of different places really quickly without impacting your credit score as well. But if you do need to submit a full application, that second hard check is going to be no worse than the first one that you have to get anyway if you're going to get a private.
So that's why we do encourage people to shop around and get multiple rates. You're going to have to get at least one rate, right? Because if you need to borrow. So if you kind of like have all your ducks in order and are ready to go, if you get that first quote, then honestly get at least 2 other quotes. It won't impact your rate worse than the first quote, and then you have more information to make a better decision.
And just to touch on this, there's just one question on, do you have to unfreeze your credit report to do a rate check? And the short answer is yes,
Yes.
you do.
Yes. Okay. Are there some places that are known for lower rates, federal versus private? So okay, this is our last question to answer because this is a good one. The question people always say is, where can I get the lowest rate? And then you might hear somebody got a low rate, from one particular lender, and then you go to apply there and you didn't get that low rate. So why is that the case?
Yeah, that's the case because when you see a set of rates that are advertised, you'll typically see something today like 3.09 to 15% is a range. And lenders aren't going to tell you what everything looks like in between those 2 bookends. The way that the law works is they're required to allow a certain percentage of people who get approved for seeing rates to have an offer that includes whatever that lowest rate is. But it's a very small percentage of people. And the vast majority of people are going to get something a lot higher. That super low rate that's sometimes available from one place to the next, that's typically associated, not always, but typically, with a 5-year repayment term and immediate repayment, meaning that you have to make full payments before graduation while the student is in school. And that's pretty unattractive. Very, very few people end up choosing that as an option for a student loan. And they'll often end up, even if they'll get it, they'll say, okay, I got that, but my next option, even from the same lender, is a lot more expensive, but it's for a different repayment plan that I can't afford and I do want to use. And so the bottom line is lenders change rates quite quickly from week to week at this point. Whoever was the lowest rate for you today might not be tomorrow. And there's a little bit of luck involved in getting whatever the lowest rate is that's been advertised, because in some ways it's set up as a teaser rate to get people to check their rates. You might qualify for it from one place and not from another, and a week later that could switch.
So when you hear that somebody else, got a low rate, it's really hard to compare. You can never really compare apples to apples because you don't know, what the terms were that they chose for the rate, and you also don't know their financial profile. So it's definitely tempting, and you should, you can apply to that lender, but there's no guarantee that you're going to get the same um, rate that that person did. And even if everything was identical, as Chris said, rates might change week to week. Okay. Any other question here, Chris, you want to answer? A few ones that just came in?
That's the last one here is I see a repeated question just about federal versus private. Just the way to think about it for right now is for the Parent Plus loan, federal, your rate is 8.94% for the loans that are taken out this year, plus a 4% origination. Uh, and the private loans, so when you're looking at a private loan, you really want to compare against that. If you just Google search join Juno federal versus private calculator, or you go on our website and select it from our resources section, that's the easiest calculator you'll find that lets you compare the cost of the Parent Plus loan with its origination fee to any quote that you're getting from anywhere for any structure of a private loan. And so if you are thinking through, is this actually cheaper than Parent Plus or not? I'd encourage you to maybe use that calculator as the guide to do so.
Okay. Well, somebody did ask if their question wasn't answered here tonight, or maybe they didn't want to ask the question because it was, more personal. They still get it answered if they reach out to Juno?
Absolutely. Absolutely. I left my our support inbox there, and someone should be monitoring that 24/7 right now.
Okay. Well, thank you everyone for showing up. Thank you, Chris, as always, for your time and your expertise. And we do have one more AUA scheduled for August 15th. It's during the day. It's a Friday at noontime. If you still have questions, and it's perfectly fine, you'll be receiving an email notification about that. So show up then. But hopefully, I cross my fingers for the people who are here tonight. You could have figured out what you need to figure out by then. But if not, feel free and show up and ask us whatever questions you have then. Okay. Thanks, everyone. Thank you, Chris. And
Thank you very much.
see you again soon. Bye.
Bye.